Hello and welcome to the first module in a series of videos designed to help both beginning traders and advanced traders alike, covering a wide range of topics in the Forex market. In this particular video, we'll be discussing some of the basics of modern trading, such as how prices are created and displayed. This, of course, will bring us to one of the more simple tools that virtually every trader in today's world employs, which is called the candlestick chart. We'll be going over how these charts are built, how they work, and how they can be used in your advantage in your own trading. Have a technical analysis sort of point of view for the markets. Okay, back many years ago, a trader in any market, including currency and stock, things of this nature, would be limited to what is basically what you see here. This is a spreadsheet of prices. This is an actual spreadsheet of prices for the euro US dollar, broken up by minute intervals. And as you can see, by the date and the time over here on the left, and the prices, there are quite a few. Obviously, this doesn't really lend too much to technical analysis. You really can't get too much from this, but a whole series of numbers. So technical analysis back a long time ago before candlestick charts were introduced was a little bit more difficult, as you can imagine. People actually used to draw price charts by hand with this information. So as you can see, and this is a lot of information to digest. This is only, this is thousands and thousands of rows, and this is only about a week's worth of information. See, as we scroll down and the rows get into the tens of thousands, it's only about a month's worth of information. And that's only from one currency pair. This doesn't really lend much to the technical analysis trader, but as technology has progressed and come further along, so has the technology in displaying this information in such a way that would be easier for somebody to understand. Fast forward to something that's a little bit more modern. You'll see this is actually the same information, okay? But what I've done here is every single tick, which is basically every single one of these rows, is being plotted in real time. This is actually real-time chart, and this is what's called a tick chart. So you'll see it's updating every single time something comes in, every single time a new tick or a new price comes in. All of these other data points are moved back and a new one is added to the front. So as you can see, if I zoom out just a little bit, this actually lends itself quite a bit more to the technical analysis trader and pretty much any type of trading in today's modern world. You can actually see what a price is beginning to do. It's beginning to, go kind of sideways, move up, move down. It becomes a lot more easy and a lot more clear to kind of see what's going on and to be able to forecast what's happening with currencies. So you see I can actually switch to different currencies here, and by taking a look at their tick charts, we can see visually when something is moving up, is moving down, or moving sideways. So this is a raw tick chart. This is literally just drawing a line representing each time a new tick or a new price comes in. So what a candlestick chart is it takes this exact same information, but it adds a time element to it. By adding time into the equation, we're able to take this exact same information, condense it down even further into something that we could use to display what a currency has done price-wise over a given time period. If you'll see, this tick chart has no time element involved at all. Every time a new tick comes in, every time the price changes, basically, the whole chart is moved back and a new tick is added onto the front, which creates this nice, nice flowing tick chart. But if we were to say take the same information and display it in a different way, we can say over the past 5 minutes, this is what the currency did. For the past 15 minutes, 30 minutes, and so on, and then begin to plot those next to one another to create a different type of chart. And that's what's known as a candlestick chart. To build them, it's actually fairly simple. And there's really only two types of candlesticks that you can have. One is called the up candle. Basically what this is it shows that the currency over a given time period has moved up. So you'll see there are 4 different aspects. There's the high, the low, the open, and the close of a candle. The open says that during this time period, this is the price that we opened at. So For all of the examples that follow, we'll say that this is called an hourly chart, which is every candle represents 1 hour of price movement. So the the specific hour, would open at a certain price and close at the end of the hour at a certain price. Now, if the close price of the candle is above the open price, which as you can see in this case it is, it's going to be an up candle or a bull candle. The two wicks at the top and the bottom show the highest point that the price reached and the lowest point that the price reached. So if you can imagine this candle, you would say we opened at this price, we continue down to the very low point here within the hour, went all the way up to the very high point here within the hour, and then closed at this point. Alternatively, there is another candle which is basically just the opposite, and it is called the down candle or the bearish candle. Now, the difference between the two is this one is simply the close price of the candle is below the open price. So you'll see at the beginning of the hour, we opened at a certain price. The highest point that we reached is displayed by the top wick. The lowest point that we reached is displayed by the bottom wick, and the close is displayed here. Now you'll notice that the down candle has a red body and the up candle has a green body. And usually this can be colored whatever you wish it to be colored based on the charting platform that you're using, but the two general colors are green for up and red for down. That's how you can easily distinguish between a bull candle and a bear candle, or an up candle and a down candle. Now if you were to take this same tick chart that we were shown before, which is every single tick that comes in, a new point is made, and you were to separate this by time, basically saying at the beginning of every hour, start drawing a candle, and at the end of every hour, complete the candle, you would end up with something very similar to this. Now if I zoom in a bit, you can see the exact same information that was displayed on the graphic a minute ago. We've got the different parts of the candle, and both candles are distinguished by their color. We have an up candle, which is here, which is green, and this is the bear candle, or bullish candle, excuse me. We have our open price, which is down here, which is the bottom of the body. We have our close price, which is up here, which is the top of the body. We have our upper wick showing the highest point that it reached, and we have our lower wick, which in this case is very small, showing that price at the beginning of this hour, which is, if you'll notice over here, this is the candlestick for March the 13th of 2014, beginning at 7 o'clock in the morning. We actually began at this price, which is 1.3901, and went all the way up during this hour to 1.3941. We had a high of 1.3947 and a low of 1.3900. So if you were to take all of these candles that you're building and put them together, you get a standard candlestick chart. You can actually use different time periods, which is, you can assign each candle a different length of time. So now that we've introduced time into the equation, we can actually make each candlestick a different length of time. So if I were to this is an hourly chart. That's what we were speaking about previously. Basically, it's each one of these candles represents 1 hour of time and the price movement that occurred within that hour. You can actually switch to something like the 30-minute chart, which gives you each candle representing 30 minutes. So you can see here, this long candle, for example, this long upwards candle, by switching to a 30-minute chart, you'll see that it breaks it up into two candles, obviously because there are two 30-minute time periods and a 1 hour. Go down even further to a 15-minute, you can see that it breaks it up into 15-minute candles. You can go all the way down to 1 minute, and in some cases even shorter than that. So each of these candles on a 1-minute chart represents 1 minute of time and shows exactly what price is done during that 1 minute. At a very basic level, almost every trader in the world uses a candlestick chart at one point or another. It is a very efficient way of displaying how currency moves, or how any instrument moves, over price over a length of time. You can actually go the other way with it too, go all the way up to each candle representing a week or a month's worth of time. But for the time being, we'll go ahead and stick to the hour. A candlestick chart is literally nothing more than a price indicator. It's showing us, using price data, it's showing us exactly what a currency pair did and over what period of time. So you can actually use a price chart as an indicator, as a way to determine what the price is going to do based on how it's moving. People generally refer to these as candlestick patterns. Basically, the candlesticks show certain patterns that indicate whether or not it's going to be reversing, or the price is going to be reversing, continuing, whether it's got strength or weakness, and all sorts of different types of information. So let's kind of explore a couple of those candlestick formations so we can better understand exactly how candlestick charts can help us determine in what direction the market will move. One of the first patterns I'd like to cover is a formation. It's called the Doji candlestick formation. And this is one of the oldest patterns that you're going to find around, but it's one of the more powerful ones because it signifies whether a trend is going to either continue or reverse. So you can see here, this is basically the definition of a doji on the left here. So doji is formed when the opening and closing prices are virtually the same. The length of the shadows, or the wicks as we call it, can vary. If you'll notice by this picture, it doesn't really look like the other pictures of the candlesticks I showed you because it doesn't have a body. Basically, the open price and the close price is the same. In the case of this example doji here, it means that price opened, moved around quite a bit, and then closed at the exact same place. And we'll get into the significance of that here shortly. There are a few different ways that a doji can form, and these usually mean different things. The dragonfly doji means that we opened, went straight down, came straight back up, and closed at the exact same price, or very near the exact same price. Basically, what you're looking for is for the candle to have no body. You'll see it's formed when the opening and the closing prices are at the highest of the day, or the particular hour, or the particular time frame of the candle, excuse me. So it could be the opening and closing prices are the highest point of the hour, or the minute, or the 4 hour. It depends on the time frame of your candles. If it has a longer shadow, it signals a more bullish trend. The shadow, once again, meaning this wick here. And a bullish trend means it's moving upwards. So if we open and we have a pretty long shadow that points down, but you got to remember by the end of this candle, it turned around and rocketed back up. So it's basically a continuation of an upwards trend. When appearing at market bottoms, whenever the market has been moving down, it's considered a reversal. So a candle formation that looks like this is very indicative of the market moving in an upwards direction. The gravestone doji, as you can imagine, is pretty much the exact opposite. It's formed when the opening and closing prices are at the very bottom of the time frame for the candle. It has a long upper shadow or wick, and it signals a bearish trend, basically saying that during this candle, it went up and then we rocketed back down. We covered the entire distance, and it basically signals that we're going to continue in that downward trend. If it's at the top of the market, it's considered a reversal candle, which means that we should be continuing downwards. And if it is in a downwards trend already, it basically signals the continuation of the trend. So if you were to break it down, the dragonfly basically means that the market is pointing toward an up direction, and the gravestone is pointing toward a down direction. Now the long-legged doji, which is basically a doji candle with, fairly long wicks at the top and the bottom, indicates forces balanced in opposition. Basically, this is saying that the price has moved rapidly back and forth within this candle and closed at the exact same or near the same price that it opened. And depending on your style of trading, you may actually want to avoid the market when you see dojis of this nature, because they signify that the market hasn't really picked a direction just yet. So let's go ahead and take a look at some real-world examples of dojis. Okay, so this is a US Swiss 4-hour chart, and I've actually marked with text where each of the dojis are. The doji formation here on the left, the far left, is more of a gravestone doji. And if you remember, it is a price basically where the open and the close are very close to the bottom. And this signifies that price shot up after opening. It shot up a pretty decent amount, and then before the candle closed, came straight back down and closed almost where it opened. This is basically signaling that we are going to be moving in a downwards direction, because remember, if it takes a lot of movement for price, especially whenever the open and the close are at the bottom of the candle. It takes quite a bit of price movement to go straight up and then straight back down. It's basically creating a peak, and that's exactly what doji signify. So you'll see our open is near the bottom of this candle. We have an upwards wick or shadow of much longer than the downwards wick, and then we closed about the same price. So after we have our upwards movement and we have a formed doji, let's take a look at what price did afterwards. So it was a pretty strong indication that price was going to continue down just by using the price action of the candles. You'll notice in each one of these instances, all four of these doji examples, market either reversed quite a bit, or on the very next candle continued and to create a huge body on the candle, one of pretty sizable nature. So dojis are a very good way of telling you that the market is going to move, in a decently strong direction in one direction or the other. And they always like to appear at the top or the bottom of trends. So they like to show reversal every time that they appear. So the dojis are an extremely powerful candle formation and should always be looked for when trading any currency. As you can see, there are some other one candle patterns that basically extend upon the doji. Like a hammer, for example, actually physically looks like a hammer, but it's a doji with a bit of a wider body, with both the open and close at the top. And each of these signifies something different. So a hammer is a black or a white candlestick, or basically meaning an up or a down candlestick, that consists of a small body near the high with a little or no upper shadow and a long lower tail. So basically, this is the body here. It's got a very small or virtually no upper wick, and the lower wick is quite large. It's usually about double the size, if not more, of the entire body of the candle itself. This is usually considered to be a bullish pattern during a downtrend. So basically, if we've got a downtrend going, we get something that looks like a hammer, then usually it signifies a reversal of the trend. We're going to end up going back up from this point. And like most candlestick patterns, there's always inverses of the pattern itself. So the inverted hammer means pretty much the exact same thing, but flipped in the other direction. So it's got a black or a white candlestick and an upside down hammer position. So it's could either be a bull candle, it could either be an up candle or a down candle, with the top wick being very large. So if we are in a downtrend, for example, and say this is a white candle or a green candle, which means that it's a candle where the open is below the close, the close is above the open, then in this case, thinking about how this candlestick was formed, we opened at the bottom, went straight up, turned straight back around, and closed above the open. There's this small body here. So in this case, it means the opposite of the hammer. If we're in an uptrend and we get an inverted hammer, it's usually a signal of us reverting and continuing downwards. It's basically a reversal pattern. Shooting star is somewhat similar, except the body is extremely small, and usually there's no wick at the very bottom. So a black or a white candlestick that has a small body, a long upper wick or shadow, and a little to no lower tail is considered to be a bullish pattern in an uptrend, or a bearish pattern, excuse me, in an uptrend. So hammer, inverted hammer, shooting star, and most of the dojis are basically indicative of reversals. So the hanging man takes this concept a little bit further. It's a black or a white candlestick that consists of a small body near the high with little or no upper shadow with a long lower tail. So no upper wick and a long lower tail. And once again, this is basically a reversal pattern, but this is a much stronger reversal pattern considering the candle closed down, signifying that it's going to continue in that direction. So say we're in a market condition where the market is moving up, okay, and we open at the top here. We continue down quite far and we come back up to a point where we couldn't even make it. The market is pushing down so hard we couldn't even make it back up to where we started. So we end up with a down candle pointing down, and this is a really indicative of a reversal in an uptrend or a continuation in a downtrend. One more very important single candle pattern is Maru Bozu. And I've heard of this referred to as the no wick candle or a overextended candle. Basically, it is a long, normal candlestick, up or down, black or white, with no shadow or no tail. It's basically just a brick of price. It opens at one location, continues straight down without any sort of retracement, and closes. And so this is a very strong continuation pattern, a formation, if you will. Okay, let's take a look at a couple of these in action before we move on to a couple of multiple candle patterns. Now here's an example of two actually right next to one another. We have a hanging man, which is this one here, this red candle. We have a shooting star, which is this green candle. Now if you remember, a hanging man is basically has a very large body at the top and then a long wick downwards, okay? And this is basically signifying in a downtrend the end of the downtrend, okay? Because we have opened here, we can just zoom in well, actually this is as close as I can zoom in. We have opened here near the top, if you'll see, and then we went straight down with our pricing, but we went down far enough and came back quick enough that we were actually be able to create it. Still a down candle, but it's basically bouncing off of this bottom here. So we created this hangman during a downtrend. So it's a down hangman during a downtrend, and it's giving us the signal that we're going to be reversing soon because we pushed all the way down and then had that pressure come back up. So this is a hanging man right next to the shooting star. And if you'll remember, a shooting star is basically a reverse hammer, okay, with a smaller body. So it's a bigger body than a doji, but a smaller body than a hammer. This is saying, especially right next to a hangman, the market shot straight down. It's coming straight back up, which gives us this nice hangman formation. And since we hit off this bottom and have this nice pressure moving to the upside, the shooting star is quite literally saying, okay, we opened at this price, we tested, we moved back up, but we didn't have enough down pressure to push this back down and make another red candle here. So this is an obvious formation that we're actually turning around and moving toward the upside. As you can see, over the next few candles, we did the exactly that. Now moving over on the same chart, I found a really nice, almost perfect example of an inverted hammer. Okay, and if you'll remember, in an uptrend, an inverted hammer is basically signifying that we're going to be reversing toward a downtrend. And the reason for that is we have these series of green candles, series of up candles. So we've got the market moving in an upward direction. Okay, once we get to this inverted hammer, we opened at this price, at the bottom. We moved up and then we pushed back down and created a hammer that's basically upside down. So we created this top here and tested the top in a series of up candles. And if you'll notice, especially when the inverted hammer has a wick at the top that is bigger than all of the previous wicks for this small little up movement. This is definitely signifying, because we tested this top and we are pushing back down, the inverted hammer definitely is beginning to signify that we're going to be changing direction. And as you can see, that's exactly what happened. So most single candle formations are signifying in one way or the other that the market is going to be reversing the direction that it's currently moving. Okay, so almost everything that I've shown you so far, whether it be doji or both of the hammers and things of that sort, are basically signifying, okay, if you're moving in an upward direction and you get something like an inverted hammer, you're going to be reversing direction just based on price movement, reversing direction and moving back in the other direction. So candlestick formations are basically an easy way of showing you visually what a price is doing, and by making these formations, it's telling that the market is going to be reversing. Now, if you'll remember, there was one called the Marubozu that is a continuation pattern or a continuation formation. And what this is basically saying that if we're pushing in one direction pretty hard and we get this large candle, we're usually going to be continuing in that direction, like this example here. So generally, if the price begins to move up, you have a series of up candles in a row, And then you come across something like this. It's got almost no bottom wick and almost no top wick. It's usually indicative of continuing in the same direction, simply because there is no downward test, if you will, in this movement up. As soon as it opens, it continues all the way up. The upward pressure is very strong and it closes very near the top. So that usually continues, or usually says, at least for a few more bars, that this specific trend should continue because it has a lot of power to the upside or the downside, depending on which direction the candle is currently facing. Once you get the basics of the formations of a single candle, you can begin to kind of pair them together and come up with what's called multiple candle formations. Now, these are usually quite a bit stronger than the single candle formations. They tell you a whole lot more about the market and how the market is currently moving. The first one, and actually one of my favorites, is it's a two candle pattern. And it's telling you, regardless of the current trend that the market is moving, it's telling you that you got a lot of pressure to one side. So what's happening here is you'll see it's actually outlined in this blue box here. We've got this first candle, the first one that we're looking at, which is this up candle here. We open at this price. We have a lot of movement, but we close about in this area here. Well, the open of the next candle is much higher, okay? It's much higher and it engulfs completely the body of the previous candle. So first candle has a small body, the second candle has a big body that engulfs the entire candle. And usually this is a very strong sign that we're going to be continuing in the candle direction that is pointed to by the second candle. If you'll notice, this is a daily chart. And if you'll remember how these candlesticks are formed, each one of these candlesticks represents a day. Okay, this isn't a very common pattern simply because the Forex market's a 24-hour market. So there's really not much chance of one candle closing and another candle opening at a much different higher or lower price because the market is a 24-hour market. However, over the weekends, you still have movement in the currency. So as the next day opens up, which is exactly what's happened here, you can have the opportunity of what's called a gap. So this gapped up and then engulfed completely the previous candle. And if you'll notice, for many days after that, we continued down. Fun enough, I know how I say it's as rare as it is, but it happened again right here. I'm just noticing this. The market opened up, and we had a pretty decent move upwards in a downward trend. We closed here, which gave us an up candle. On the very next candle, we actually opened up higher than we closed, and we engulfed the entire candle downwards. And this is, since the market's kind of moving in this direction anyway, it's a pretty strong continuation that we will keep continuing down. And to a smaller degree, you'll see it happens over and over. It happened here slightly. It happened here slightly, and it happened here slightly before the market started moving sideways in order to pick a new direction. Once you become a little more skilled in picking out these single candle patterns, you'll see that they start to form patterns together. This is another really good one. This one's called the evening star. Okay, it's a 3-candle pattern. We have this up candle, this top candle, and this down candle. Okay, and this is usually signifying the reversal of either a short-term or a long-term trend. Okay, so we have the market, which, once again, this is still a daily chart. We have the market over the past week or so before this happened has been moving up pretty consistently. Okay, we have this nice big candle, this nice big bullish candle. We have a hammer with a longer wick up top, and it's pointing downwards. And then we have this huge candle pointing straight down after that. And this is called the evening star. Basically, what this means is that the market has been pushing up for so long that we have one of our reversal candles that we were talking about earlier right here. And then we have a large push downwards, which means that the market rounded around its top and is beginning to fall. And so for the next week or two after that, the market continued down at a pretty aggressive pace. So this is a very important pattern, the evening star. And there are different variations on this pattern as well. Like, say, for example, this the candle in the middle, instead of being, a Sato hammer candle, if it was a Doji, if the open and close price were almost exactly the same, it would be a very strong indication of the market moving downwards for quite some time. Okay, the last multiple candle pattern that I want to share with you is actually somewhat just slightly more advanced. It's not specifically just the shapes and the formations of the candles, but it actually gives you a really nice breakout situation. And what I mean by that is its particular formation actually shows you at what level a breakout, like a movement, a strong movement in one direction or the other, is expected. Okay, as I show you this pattern, just think about how candles are formed and what price is doing to make these candles do what they do. Okay, so we have this box here, and what I'm really trying to focus on is these two candles, this red candle here and this green candle here. I'm gonna go ahead and delete this box so you can see this a little better. But if you'll notice, this red candle has an upper wick and a lower wick, and this green candle has an upper wick and a lower wick that are inside the red candles. Okay, so we have a strong movement downward. We have this nice big body, basically saying that we opened, went up a little bit, straight down and came back up. So we have movement to the downside. Okay, but the very next candle, and this is especially true on like daily charts and things of that sort. This very next candle is the market squeezing down. You know, it's moving back and forth in this little area right here. So we have a very unique situation. Okay, I'm going to go ahead and draw these horizontal lines at the top and the bottom of this particular candle. Okay, so we have a body of our second candle that's in the opposite direction. You know, so this one's a down candle, this one's an up candle. This one's in the opposite direction. The body is completely inside the body of the previous, and the high and the low are completely inside the high and the low of the previous. Okay, so we have a candle that is smaller in every way, shape, and form than the candle before it. Now this gives you the opportunity to have a breakout level at the top and the bottom. Okay, so it's the market squeezing down, condensing smaller and smaller and smaller. And then whenever it finally does break at the top or the bottom, you'll generally have a situation to where you might be able to pick up a very large trade, because as the market condenses and squeezes down, it gets to a point where it needs to break out. And that's exactly what happened here. So this candle formation is actually called the inside bar, and it usually looks exactly like this. You have a body that's inside the previous body, and the wicks are inside the previous wicks, which allows you to draw an upper and lower series of horizontal lines to serve as breakout points. In this next module, we're actually going to expand on this idea a little bit more. These two breakout points at the top and the bottom are called support and resistance. So you have an area of support and an area of resistance. These on their own can be extremely powerful trading tools and actually can be used to confirm or deny certain types of trades. So in the next video, we're going to look into this a little bit more and cover what it is and exactly how to use it.